The Middle East ceasefire was extended, but uncertainties too. Then headlines change fast and market reaction is volatile and sometimes unpredictable as well. In this context, earnings continue to flow in to give investors something other than the Middle East talk to think about. And Tesla is due to report its earnings after the bell today and will revive debate regarding whether its AI growth story could overtake and overweight on the company's struggles in the EV space. So welcome to Swissquote's daily Market Talk. It's Wednesday, April 22nd. I'm İpek Özkardeşkaya, and everything I will discuss in this video is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So the ceasefire in the Middle East has been extended, yes, despite Donald Trump's early threats this week that it was unlikely to be extended and that he would rather bomb the heck out of the country's infrastructure, especially the power plants. That is yet another signal or proof that the US is probably losing control in the region, and it's important to look past the noise that's injected in the financial markets and in the headlines by tweets or even official announcements and statements from the White House and the president, because they carry an increasingly lighter weight in terms of what will happen in the Middle East and what the US could control or it could no longer control. So the US futures are higher this morning at the time I'm talking here, following a retreat in yesterday's trading session, while European equity futures were in the negative before and they're turning positive as there are news that Iran could eventually accept to join in the talks if the US lifts its blockade, and the US could reportedly do so according to the latest news. Now looking at the Asian equity complex, they're also trading with little conviction this morning on the idea that this conflict is prolonging dangerously beyond a few weeks. As it was announced at the start of the war, the Strait of Hormuz remains almost closed. The US has put itself in a very, very difficult position that it can no longer politically or geopolitically justify, and no one really knows what is next in this war. Again, a hint this morning that Iran could eventually agree to talk with the US and that the US could lift the blockade for Iran to come to the negotiating table is giving some hope this morning, but to be seen. What is clear, however, is that the energy reserves are drying up across the globe. It is said that the Europeans are now left with around 6 weeks of oil and energy reserves, after which we might see further disruptions heading to shore in Europe, and that beyond just energy prices soaring, we could eventually see energy scarcity, mass flight cancellations, and so. But despite prolonged risk, the energy prices are giving a muted reaction to extended ceasefire news this morning. US crude would jump more than 5%, testing a key Fibonacci resistance yesterday to the upside, is slightly down this morning, trading just below the $93 per barrel mark, as the tightening supply story is now being countered by a demand destruction story, keeping the upside pressures limited when rallies occur here. And if you lean into the technical levels, the $94 per barrel level, which is the major 38.2% Fibonacci retracement on year-to-date rally in American crude price, should distinguish between the actual bearish consolidation zone and the continuation of the year-to-date rebound. And on the upside, above the $100 per barrel level, we will likely see a solid psychological resistance, because this is a level that could give more weight to the falling demand story on higher energy prices than to supply tightening. So in summary, it's quite difficult to talk here because the headlines change as I talk, but the short-term volatility in oil prices is set to continue, while the prices will likely remain at significantly higher levels than before the Iran war started. The chances of a sustainable upside move remain limited, as the higher the energy prices, the lower the demand. But that's just theory, and the latest news actually back the fact that the European refineries are cutting their demand due to higher prices. But it's not true for everyone, because you know who doesn't cut demand? American consumers. Their consumption has not been impacted by the bloody war in the Middle East that disrupted the global supply chains and sent energy prices soaring across the globe since almost 2 months now. In fact, yesterday's economic data from the US showed that the US retail sales jumped by most in a year. That was expected because those are not inflation adjusted figures. So part of that jump is obviously and naturally attributed to the jump that we saw in oil prices. But the report also showed that almost every single category, including furniture, electronics, to general merchandise, also printed increases. And that matches with bank announcements last week during the earnings announcement that US consumer spending remains resilient. For how long? I don't know. I guess we will see. But for now, Americans continue to spend. They get less for a dollar spent, but they spend nonetheless. As such, the US 2-year yield jumped yesterday as the economic data from the US didn't bring any urge for cutting the interest rates from the Fed when inflation is also expected to pick up in the coming months due to the Middle East pressures. The US 2-year yield jumped to 3.80% level. Then the Fed chair nominee Kevin Warsh said at his Senate hearing yesterday that he will not be a sock puppet to the White House and to the US president, and that he would make monetary policy decisions independently himself. So maybe I'm thinking that also helped pushing yields higher in the US yesterday. Mr. Warsh, however, insisted that rate cuts are fairer than balance sheet expansions for the monetary policy and good for everyone because yes, they mostly benefit people who actually do have exposure to financial markets and not to everyone. And that he would like to work also with the US Treasury to make this balance sheet smaller. Well, that's great news, but the problem is the timing is challenging as the world is now dumping their US Treasury holdings due to hectic and no longer reliable US foreign policies. So I can't wait to see how this balance sheet reduction will play out. In the FX markets, the US dollar, which was a clear winner in the first weeks of the Iranian war, lost that positive momentum a while ago, and the dollar index is now back to its pre-war levels and falling. The euro dollar, on the other hand, successfully rebounded before reaching a key Fibonacci resistance on Trump inauguration to date appreciation as the dollar yen hovers a touch below the 160 level, but barely test this level on worries that an additional pip higher could eventually trigger a direct FX intervention from the Japanese authorities and wash out speculative positions. Elsewhere, the data also showed that the producer prices in Korea hit a 3-year high amid rising energy prices due to the Middle East war, as the Kospi index slightly retreated from an all-time high level. At the time I'm talking here, we were talking yesterday about how the technology is now coming back to the stage as a safe alternative to other sectors as the AI demand remain resilient faced with the war news and the energy crisis, and then the sector continues to grow quite rapidly. That narrative remains in play as we are moving toward the earnings season. And you know what? The Korean memory chip makers have quite a strong pricing power right now due to a deep shortage in this memory chip market, meaning that they could very well reflect the price increases onto their customers to protect their margins. Therefore, the rally here will unlikely fizzle out due to cost pressures. Elsewhere in technology, Tesla is expected to announce its latest quarterly update today after the bell. The consensus points to a roughly 13 to 17% revenue growth last quarter, flattered by an easy comparison base after last year's weak quarter on Mr. Elon Musk's political mess, remember. But, and happily for Tesla, the real debate here isn't how many cars Tesla managed to sell last quarter and how much it earned from these sales. It's whether Tesla can convince investors it is still an AI growth story rather than a slowing car maker. Because challenges are piling up. Deliveries already miss expectations, pricing pressure, fading EV subsidies, and aging lineup are waiting on auto margins. Then heavy capex, which is expected to be more than $20 billion this year, is raising concerns about cash burn in the company and execution risk. And the Chinese competition is very rough indeed as well, because BYD just announced aggressive recharging numbers yesterday, saying that its new cars will charge from 10 to 98% in just 6 minutes, and charging to 35% will take up to 1 minute only. So against that backdrop, the ball has shifted quite dramatically, and markets will care less about the first quarter numbers and more about Elon Musk's narrative on robotaxis, AI, and new growth engines to justify the company's valuation, because Tesla, as other Western car makers, is now falling off the EV race. They're only left with investors still believe in the strength of their overall market, environment, and the democratic values that, however, are increasingly at jeopardy today. And Tesla's PE ratio stands near 320 today as I'm talking here. So let's say good luck to Elon Musk for these earnings announcements, and cross fingers. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. It is very important for us. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.